right, now one look at Friday's employment report, and traders began to wonder how soon before the Federal Reserve starts to raise interest rates. It was enough to send the dollar higher and oil and gold lower. A connection? Perhaps. Let's find out. We have Lawrence Eagles, global head of commodities at JPMorgan Chase. He has been watching all of the details. Lawrence, good to have you with us. Thanks so much for coming in. So, all right, give me the connections that exist. We've all been talking about, you know, lower dollar means higher stock prices, means higher commodity prices. Any change?
I don't really think so. Certainly, this shows we're on a growth path, but I think we've certainly been expecting that for quite a few months. I think the other indicators have been showing we're on the way up. It was only a matter of time, I think, before we had a good jobs report. The Fed, however, came out today, and Bernanke said, well, still a little bit fragile. And our personal view is that we're not going to be seeing interest rates rising significantly until end of 2010, more likely 2011 in the first half.
All right, so let's say it's 2011, first half of 2011. That's a long time away. So does the dollar continue to decline, and as a result, we just kind of creep higher in terms of commodity prices?
Well, I think one thing you have to recognize is that a weaker dollar acts as a stimulus to the U.S. economy anyway. So the question is, how fast does the dollar fall, how far does it fall, and whether it actually forces some kind of policy response perhaps a little bit earlier. But I think as long as you have the large amounts of liquidity in the system and the low interest rates, both in nominal and real terms, the ability of people to look further forward, to look to take advantage of, I mean, in commodity terms, to look at the bigger picture and the longer term picture is enhanced, and that probably means higher prices.
All right, so what about higher prices for gold? I mean, we saw gold pull back on Friday. We saw it pull back today. Does this bode well for the price of gold? Do we get some kind of consolidation and then move higher, or where do we go?
I think what the action over the past couple of days shows is how fragile a gold rally is. And a gold rally is always fragile. It always tends to be dictated by investment flows. It's just the very nature of gold. And as such, if you see a change in conditions, it's going to flip back. And you have to remember, if you just look at it in terms of a pure commodity, and there's so much of the stuff above ground, it's not transformed. And if you look at the mine supply that come out, well, you know, you're talking about a marginal cost of production which is half the current level. So it's not as if we're looking at a constrained supply environment going forward, but we're looking at investor buying, and we're looking at central bank.
Well, I was going to ask you, so what to make of all of that? I mean, the central bank isn't going to go in, you know, the Central Bank of India, for example, isn't going to go in and buy all this gold and then on, you know, Friday say, all right, sell the gold. We made enough money. I mean, this is a long-term strategic change, isn't it?
It's definitely diversification of reserves. And there's absolutely no doubt in my mind that countries east of Suez want to diversify where they can away from dollar-based reserves. Their options are limited, though. So they're still going to have to buy dollar reserves, but gold on the margin, you know, will prove an asset for a lot of central banks, and I think a lot of other G8 central banks will be looking at their own situation, saying, well, should we continue to sell going further forward? And they've certainly gone on hold for the moment. I think that's a bit more debatable, but I think there are plenty of developing country central banks who would like a little bit more gold.
A little bit more gold. So does that mean that we might get a little bit, as you said, I mean, I understand the caveat that any gold rally is fragile. Does that mean that we creep higher? I mean, do we go back up above 1,200? I think some people have been saying, you know, 1,500, 3,000.
I think picking the absolute level in gold is very hard. We're already rising very, very rapidly, and we've already risen a long way. I think the one thing that you can guarantee is that when gold ends this rally, it will be an extremely violent sell-off. But as long as the liquidity is there and interest rates are there and people are still concerned about inflation and dollar weakness, the market will carry on going up.
All right, let's talk about oil now in the same context. I mean, one of the things that we've learned recently, right, is all of this oil that is sitting in storage. About 3% of the tanker capacity is now devoted to just storing oil. Everyone thinking that the price of oil is going to go higher. Is that going to make sense?
Well, I think you have to look at what's happened over the over the past week or so. We've seen a very sharp rise in tanker rates. Now, that's normal around this time of year, but suddenly, as soon as tanker rates start going up, there's a bit more oil offloaded onto the spot market. So the market has its own stabilizing factors.
Because they can't unload too much of it too quickly, otherwise the price is going to be depressed.
Well, you depress it, you create an advantage for someone else. The reality is you're in a relatively finely balanced part of oil. It's not like gold where you could buy a small bar and stick it in your back pocket. Oil, you have to be a professional, you have to have it there, you have to have the financing there. Still, there are certain liquidity issues involved in that, but we haven't really seen any instance, I don't think, where we are seeing sort of excessive stockpiling beyond what the market has to cope with. What I think has happened is in the distillate market, the floating storage inventories have essentially helped funnel some of that liquidity through to refiners. And it's meant that the adjustment process has been much slower and more protracted than it perhaps otherwise would be in this vastly overcapacitated market. So we could, if we hadn't had this liquidity there, if we hadn't had the low interest rates, you would have seen distillate inventories be much lower. You would have seen the spreads fall much lower, and refiners would have probably been put out of business much quicker. So I think it's probably a healthy thing in the short term that we're able to carry this inventory over.
You mentioned the overcapacity, though, with oil right now. So does it stay in an overcapacity state?
This is refining.
Okay, I beg your pardon.
And refining overcapacity, I think, is...
Because the refiners, their margins have just gotten killed.
Yes, and that's going to stay there for years. I mean, that's not something that's going to change quickly. And you've still got all the countries, Middle East, Asia, building new capacity, complex capacity. That's going to last for a long time.